Now, you've seen the title of this video. It's no secret that I prefer ETFs over mutual funds. However, are mutual funds really that bad? Should you be selling all your mutual funds for ETFs? Watch and find out. In reality, exchange-traded funds or ETFs and mutual funds are pretty similar in nature. There's actually an abundance of videos and information online that introduces the two products. But in short, both ETFs and mutual funds consist of a mix of many different assets, mostly stocks, packaged into a fund. And as an investor, having a diversified portfolio of assets and investments is basically investing 101. In fact, I will argue that having a diversified portfolio is basically the single most important thing in terms of investing. Having a diversified portfolio reduces risk. Because imagine if you really only invest in one or two stocks or one or two assets in your portfolio, and if the company you invested in goes bankrupt, you've just lost a huge portion of your portfolio and a huge portion of your net worth. Even blue chip stocks aren't risk-free. Companies like Sears, Hertz, and Lehman Brothers all were once blue chip stocks and all went bankrupt. And the need to diversify your portfolio is exactly where ETFs and mutual funds can come into play here. Both hold a large variety of assets, mostly stocks, that can help you diversify your portfolio. Now, what's the difference? The simple answer, a mutual fund is actively managed, whereas an ETF is passively managed. Usually ETFs track some type of index, so for example Dow Jones, Nasdaq, S&P 500, or even on the Canadian side we have the TSX index. You can even buy ETFs that tracks other foreign markets. For example, I've recently invested in the ETF BBJP and EWT, which are US ETFs that tracks both the Japanese and Taiwanese markets. Now, me being in Canada, it makes it very hard for me to invest in companies in Asia like Japan or Taiwan, since no brokerages in Canada allows for Asian market trading. However, with these two ETFs that tracks both the Japanese and Taiwanese markets, I now own companies such as Toyota, Nintendo, Foxconn, Honda, and much more. And as an investor, I want to reap in the rewards of the most successful and profitable companies in Asia, and I can do that with ETFs. So how is that different from mutual funds? Well, mutual funds are, as stated before, they are actively managed. These financial institutions hire professional portfolio managers that constantly sell, buy, and trade stocks that they see fit to actively try to beat the market. So what is the market? And what is the general return of the market? So in general, the market in the US will be the S&P 500, whereas in Canada here it will be the TSX index, which are the two most commonly tracked indexes in the two countries. So since 1920, the S&P 500 has an annualized return rate of about 10%. Now, the 10% obviously isn't a straight line up. As we see during the recessions, the S&P 500 could lose as much as 40% of its market cap. So what the fund managers try to do during a recession for their fund is try to minimize the loss during a recession, and during a bullish market try to gain as much as possible to beat the 10% annualized return rate in the long run. And since the mutual fund is actively managed, the expenses are much higher of that than the ETF. For mutual funds, financial institutions have to hire a portfolio manager, and a lot of times it's a team of portfolio managers. And don't forget, the financial institutions also has to take a cut of the fees as well. All of these costs results in an average MER or a management expense ratio of a typical mutual fund to be about 2.5%, and sometimes it can be even upwards of 3%, which is just insane. So for example, if you're investing in a typical mutual fund with a MER of 2.5%, you will be paying about $2.5 annually no matter if the fund grows or loses in value. So no matter what, the portfolio managers and the financial institutions will be reaping in the rewards and benefits and profits, no matter if you're making money off the fund or losing money because of the fund. Now, $2.50 for every $100 doesn't sound that bad, but remember, you're only investing $100 here. But if you're investing in $10,000, for example, you're paying an annual management fee of $250, and to me, that is too much. The scary thing is the price of the fee is factored directly into the price of the fund. So many people either don't know or don't take into consideration that they're being charged a huge amount of money to have the fund be actively managed. Now guys, I do have one thing to point out that's very, very important here. The management fee is based on the total amount of money you put into that fund, not just your net gains on that fund. And because a lot of people don't really understand this information, I see forums and even videos online about people trying to invest their monies by going through financial advisors, and the financial advisors giving them false information, trying to make a quick buck by using deceptive measures. And that is obviously not cool. And that's the reason why I'm making this video about ETFs and mutual funds. So if you do decide to invest in them, you kind of have an idea what you're getting yourself into. Now, one big disadvantage about mutual funds is that they usually have a minimum investment requirement. So for example, for the fund Fidelity Global Innovator CIF, the minimum initial investment is $500, whereas many other mutual funds can be much higher. Also, you can only trade mutual funds once per day, as the trades are executed after the markets are closed. Unlike mutual funds, you can trade an ETF all throughout the day when the markets are open, and there's no limit to how many times you can trade an ETF, because an ETF is listed on the stock market just like a regular stock. Now, I personally find this a huge advantage because I like to have more control over my portfolio throughout the day, and I prefer not to have to wait until the end of the day to execute my trades. Now, I'm the type of person that likes to get in and out of the market as soon as possible throughout the day, and having a mutual fund really restricts me from doing that because a mutual fund you can only trade once a day at the end of the day. Also, since an ETF is passively managed, their management fee is very low. Take a look at an ETF I personally own, ZSP, which tracks the S&P 500. They have a management fee of 0.08%. So hypothetically, if I invest in $10,000 of this ETF, I'm literally paying only about $8 in annual fees, whereas an average mutual fund will cost me about $250. That is a huge difference. Well, you might be asking, sure, they might be charging me a huge amount of money, but they must be better than ETFs, right? I mean, there's no point of them charging me this amount of money if they're not going to give me a higher return on investment in the long run, are they? Well, you may think that's the case, but in reality, studies show that it's actually not the case. Studies show that in the long run, over 90% of the fund managers can't beat the market. So why the heck am I paying more money if most fund managers can't give me a higher return on investment? It's just not worth it. And if you look at this spreadsheet right here, again, this is only averages based on the information I found online. Over a 30-year span on average, if you started off with $10,000 in initial investment, you're much better off with an ETF that tracks the S&P 500 than your average mutual fund. Now, it is possible that without these insane mutual fund fees that they could outperform the S&P 500, but the studies show inconclusive evidence. So, it seems like I've been trashing mutual funds a lot, but are they really that bad? Well, it really depends. If you really don't have time to research investing and you want to hire out a professional to help you with these mutual funds, it can work out. However, history has shown that ETFs that tracks the market outperforms the portfolio managers in the long run. As for me, I prefer to park my money inside ETFs that tracks different markets and let the fund and the market do its job and go with the flow. Also, the low management fees, as well as the ability to buy and sell ETFs anytime during the day when the markets are open, makes it a clear winner to me. However, if you do decide to go on to the mutual fund route and decide to hire a financial advisor, please do your research beforehand. There are many cases and instances where the financial advisors gives the clients false or misleading information, and the clients usually find out way too late. Anyways, thank you so much for checking into my video. If you find this video helpful, please consider a like and consider a subscribe to my channel for more videos regarding financial planning, financial investing, as well as job search. Take care and stay safe.